Your life savings are most likely in a default pension fund, and you probably don't even know how it's invested. In fact, according to research by the pensions regulator, 96% of people that have a defined contribution scheme are invested in the pension scheme's default fund. So what exactly is a default fund, and is it a good option for you? Well, since 2012, your employer has been legally required to enrol you in a pension scheme, and the pension provider is obliged to offer an investment option to its members with the aim of growing their pension fund. This is typically a low-cost investment fund with some level of diversification applied. It's common for them to be a medium or low-risk profile, and more often than not, they'll contain passive equity trackers and fixed income holdings. So, low cost, diversified, trackers, what's not to like? Well, potentially a fair amount. There are some positives that come with default funds. The costs are low, as I mentioned, but also capped by the regulator at 0.75%, so you know this won't escalate over time. The primary benefit, though, is that you won't have to make any decisions at all. It's an easy solution for those without any interest in investing, and at least it's more likely to grow than holding cash. Unfortunately, though, our inherent laziness and lack of engagement with our money continues to be served by default funds, and you could be losing out as a consequence. Default funds have to try to be appropriate for everyone, young, old, risk takers, and the more cautious. By definition then, they're rarely truly appropriate for anyone. We all have different feelings towards risk, varying capacity for loss, and will have differing objectives for our money. Your investment strategy should reflect this if you want to achieve the best outcomes. Should the new joiner in their early 20s really have their pension invested the same way as, say, an employee that's been with a firm for 30 years and is starting to look towards retirement? Probably not. To deal with this issue, many default funds have what is known as lifestyling properties. When you join the pension scheme, you will select a retirement age. At a set period prior to this date, usually in the region of 5 to 10 years, the fund will start to automatically de-risk by reducing the equity exposure. Given that most individuals fail to engage with their pensions at all, it's understandable that steady de-risking towards retirement is considered a sensible generic position to take. But retirement does come fairly abruptly in many cases. One week, you're at work, and the next, you're attending your leaving party. De-risking your investments 10 years prior to this, then, seems likely to negatively impact the growth potential of your funds. Perhaps unnecessarily so as well, given that your life at this stage will look very different to how it might at retirement. It's also worth highlighting that quite a lot of default funds move entirely to cash at retirement age. This is more common in older schemes, as it's a hangover from when pension funds were typically exchanged for annuities. Now, ONS data shows that someone in their 40s can, on average, expect to reach the age of 85, and they'll have a 1 in 4 chance of reaching 95. So if you retire at 65, your pension is probably going to need to continue being invested for another 20 and possibly even 30 years. You're most likely going to need it to continue growing, so the last thing you'll want is swathes of cash or an overly de-risked strategy that doesn't align with your retirement objectives. There have also recently been significant criticisms of the 0.75% charge cap that's in place. The limitations on costs have often resulted in highly UK-centric default funds that have pretty limited asset allocations. Quantitative easing and the recent inflationary environment have just made this issue worse. Bonds and equity have become positively correlated, and rising interest rates have seen bond prices fall at a rate we haven't experienced in a while. More sophisticated alternative instruments need to be used to find diversification, but they aren't always a cheap option. This often means that default funds aren't sufficiently globally diversified and can suffer unnecessary levels of volatility due to a lack of diversification in asset classes. Ultimately, your money should be invested for your circumstances in line with your objectives, whilst taking into account your attitude to risk. The asset allocation of your strategy should be able to flex based on the current market environment and have access to a wide range of options to provide enough diversification to protect your capital in drawdown. It's unlikely that a default fund will be able to achieve all of this. Now, I'm not suggesting that this means everyone should sell out of their default funds, as unless you are an experienced investor, they're still going to be a better option than trying to build your own portfolio. However, if you have a reasonably sizable pot and can access advice, please do so. A professionally managed investment strategy supported by a robust financial plan will undoubtedly improve your chances of success. Because remember, your money really does matter.